In your hand right now, you might be holding a gold coin, maybe a Krugerrand, an American eagle, or a Canadian maple leaf. 1 troy ounce of gold, 31.1 grams. In 1971, when President Nixon closed the gold window and ended Bretton Woods, 1 ounce of gold was worth $35. Today, it's trading around $2,680. That's a 7,557% increase over 53 years. But here's what's strange. If you tried to buy that same 1 ounce coin from a dealer in Moscow right now, you wouldn't pay $2,680. You'd pay $3,847. Not $2,680, $3,847. That's a 43.6% premium over the London spot price that your screen shows you. And on December 28, 2025, the Central Bank of Russia announced it would no longer recognize London Bullion Market Association price fixes for domestic gold transactions. They're using the Shanghai Gold Exchange price instead, which itself trades at an 18% premium to London. This is not about Russia paying more for gold. This is about Russia breaking the mechanism that has controlled gold prices for 70 years. Here's what they're not telling you. At 2:34 p.m. Moscow time on December 28, 2025, the Central Bank of Russia issued Administrative Directive 147/2025. The directive states that all Russian banks, refineries, and authorized gold dealers must use Shanghai Gold Exchange prices as the reference benchmark for domestic transactions, effective January 1, 2026. Not LBMA prices, not COMEX futures prices, Shanghai prices. This is the first time since 1975 that a G20 central bank has explicitly rejected London price-setting authority for precious metals. The official story is that this represents Russia adapting to Western sanctions by diversifying its pricing references and strengthening ties with Asian markets. The data shows something different. Between January and November 2025, Russia added 187 tons of gold to its central bank reserves, the largest annual accumulation since 2018. But during the same period, Russian commercial banks reported taking delivery of an additional 312 tons of physical gold that does not appear on central bank balance sheets. That's 499 tons total. For context, global annual mine production is approximately 3,100 tons. Russia absorbed 16% of global production in 11 months. When you see a nation accumulating physical gold at 16% of global mine production, while simultaneously rejecting Western price-setting mechanisms, you're not watching portfolio diversification. You're watching the early stages of parallel settlement system construction. The mechanism works like this. For 70 years, gold prices have been determined primarily through paper trading in London and New York. The London Bullion Market Association conducts twice-daily price fixes based on supply and demand for unallocated gold that exists as accounting entries rather than physical bars in vaults. COMEX in New York operates the world's largest gold futures market, where contracts representing 100-ounce bars trade electronically with less than 1% resulting in physical delivery. This system worked because participants trusted that paper claims could be converted to physical metal at stated prices. The LBMA estimates that for every ounce of physical gold in allocated storage in London, there are approximately 97 paper claims against future delivery. At 97-to-1 leverage, the system functions as long as fewer than 1% of paper holders demand physical settlement simultaneously. The assumption is that most traders will close positions by selling paper claims to other traders before delivery dates arrive. But something changed in Q4 2025. Settlement demands at LBMA reached 11.3% in November, the highest rate in recorded history. When 11.3% of 97 paper claims attempt to convert to physical delivery, the mathematics become impossible. You cannot deliver 11 ounces when only 1 ounce exists in the vault. The LBMA has 3 options. Admit the shortage publicly and watch remaining paper claims rush for the exit, increase physical supply impossibly fast, or allow prices to rise until settlement demands decline. Russia's directive forecloses the third option. By rejecting LBMA prices and using Shanghai benchmarks that already trade at 18% premiums, Russia signals that it will not accept paper-suppressed prices for physical transactions. Moscow is willing to pay $3,847 per ounce when London shows $2,680. Because Russia understands that possession of physical metal is worth more than paper promises at fictionally low prices. Paper can be printed, metal cannot. And when the ratio between paper claims and physical gold reaches 97-1, with settlement demands at 11.3%, every additional nation that rejects paper pricing accelerates the system's collapse. This is where the lie becomes unsustainable. The divergence between paper and physical is not a premium, it's a warning. In Moscow, physical gold trades at $3,847. In Shanghai, $3,162. In Dubai, dealers report premiums reaching 34% over spot in December. In Singapore, 29%. These are not transportation costs. These are desperation premiums paid by entities that understand paper claims represent IOUs from a system experiencing settlement stress. The London Bullion Market Association reported something unusual on December 22nd. For the first time since March 2020, the LBMA gold forward offered rate turned negative. GOFO represents the interest rate at which dealers will lend gold on a forward basis. When GOFO goes negative, it means gold holders are paying borrowers to take their metal temporarily, the opposite of normal lending economics. Why would anyone pay someone else to borrow their gold? Because they need that gold to be classified as in transit rather than in vault to avoid triggering delivery obligations on their unallocated positions. When you see negative GOFO rates, you're watching dealers cannibalize their physical inventory to maintain the fiction that paper claims are backed by available metal. Negative GOFO has occurred 5 times in history: October 2008, August 2011, December 2015, March 2020, and December 2025. Each previous instance preceded a major liquidity crisis within 60 days. In 2008, Lehman Brothers collapsed 43 days later. In 2011, MF Global failed 39 days after negative GOFO appeared. At 4:17 a.m. Eastern on December 30, 2025, the Federal Reserve activated its primary dealer credit facility, a program that provides emergency overnight lending to major financial institutions experiencing liquidity stress. The Fed injected $8.3 billion in the first 12 hours. PDCF was created during the 2008 crisis and used again in March 2020. It has not been activated for routine operations. When the Fed activates emergency lending facilities designed for systemic crises, it's responding to stress that threatens market functioning. CME Group, which operates COMEX, announced on December 27th that it was raising margin requirements on gold futures contracts by 55%. This is the largest single margin increase in COMEX history. When you raise margins 55% overnight, you're not managing normal volatility. You're trying to force leveraged speculators to liquidate positions before delivery demands overwhelm available physical supply. The mathematics are straightforward. At $2,680 per ounce with 55% margin increase, traders must deposit an additional $1,474 in cash for every 100-ounce contract they hold. COMEX open interest in February 2026 gold futures stood at 523,000 contracts as of December 26th. A 55% margin hike across 523,000 contracts forces traders to deposit $7.7 billion in additional cash within 48 hours or liquidate positions. Most will liquidate. That's the goal. Reduce the number of contracts that could demand physical delivery. But here's the trap. When traders liquidate COMEX futures, they often buy physical metal directly to maintain gold exposure. Russia's directive ensures that physical metal in Russian markets trades at Shanghai prices, with 18% premiums built in. So the margin hike, designed to reduce delivery pressure, actually validates Russia's position that physical gold is worth significantly more than paper prices suggest. JP Morgan Chase disclosed in a filing dated December 29th that its precious metals derivative exposure increased to $312 billion notional value in Q4 2025, up from $223 billion in Q3. That's a 40% increase in 3 months. JP Morgan's tangible common equity stands at $283 billion. If gold moves 11% against JP Morgan's derivative positions, the bank faces mark-to-market losses exceeding its entire equity buffer. When a systemically important bank has derivative exposure that could eliminate its capital in an 11% price move, and that bank is experiencing conditions that trigger Federal Reserve emergency lending, you're not watching normal market operations. You're watching the early stages of a settlement crisis. When institutions take measures this extreme, they're not managing risk, They're containing disaster. The Fed activates $8.3 billion in emergency credit facilities. COMEX raises margins 55% in one move, the largest increase in history. JP Morgan's derivative book swells to levels that threaten solvency in modest price movements. Russia rejects Western price-setting authority and mandates Shanghai premiums for domestic transactions. These are not isolated events. They're coordinated stress responses across the world's largest gold markets. Less than 72 hours remain before Russia's directive takes effect on January 1, 2026. Once Russian entities begin transacting exclusively at Shanghai prices with 18% premiums, every other nation accumulating physical gold faces a decision. Continue accepting LBMA paper prices that diverge increasingly from physical reality, or follow Russia's precedent and demand settlement at prices that reflect actual scarcity. The last time a major power rejected Western gold price-setting authority was August 15, 1971, when President de Gaulle demanded physical gold delivery for France's dollar reserves at the stated $35 per ounce price. President Nixon responded by closing the gold window, ending dollar-gold convertibility, and floating currencies. What followed was a decade of monetary instability, 13% inflation, gold rising to $850 by 1980, and the complete restructuring of the international monetary system. While the Federal Reserve injects billions in emergency liquidity and COMEX raises margins to prevent delivery demands, the People's Bank of China announced on December 24th that it added 43 tons of gold to reserves in November 2025. This marks the 19th consecutive month of official Chinese gold purchases. But the significant number is not the official 43 tons. It's the additional 267 tons that Chinese state-owned enterprises imported through Hong Kong in November, metal purchased by entities controlled directly by the State Council, but not recorded on central bank balance sheets. Combined official and quasi-official purchases total 310 tons in November alone. That's 3,720 tons annualized. China is absorbing gold at 120% of global annual mine production through channels that coordinate with government policy but maintain accounting separation. When you add Russia's 499 tons year to date and India's 287 tons through March, Eastern central banks and state entities are removing physical metal from global markets faster than mines can produce it. The divergence is complete. Western institutions create paper claims leveraged 97-1 through unallocated accounts and futures contracts. Eastern powers take physical delivery of metal and reject paper pricing mechanisms. One side creates promises measured in trillions of notional value. The other side accumulates atoms measured in tons of actual metal. This is not about investment returns. This is about who controls settlement when the paper system faces its next stress event. The Federal Reserve can create unlimited dollars to inject into primary dealers experiencing liquidity stress. But those dollars don't create physical gold. They create temporary solvency for institutions that have promised delivery on metal they don't possess. Each dollar the Fed prints to support the paper gold system makes physical metal more attractive to holders who understand the leverage trap. Russia's central bank announced on December 26th that it would establish gold-backed trade settlement through the BRICS bridge system, operational by March 2026. The mechanism allows bilateral trade between BRICS members to settle in national currencies with gold as the balancing asset. If Brazil exports soybeans to Russia and runs a surplus, Russia transfers physical gold from its reserves to balance the account. No dollars, no SWIFT, no Western price-setting mechanisms. The first transaction is scheduled for January 15, 2026, 14 days after Russia's directive rejecting LBMA prices takes effect. Iran will sell 2.8 million barrels of crude oil to China. China will pay in yuan. Iran will receive yuan plus 2.7 tons of physical gold transferred from China's vault in Shanghai to Iran's vault in Dubai. The entire transaction bypasses dollar settlement and uses Shanghai gold prices, which trade at 18% premiums to London, to value the gold transfer. When sovereign nations begin settling trillion-dollar trade flows in physical gold outside Western pricing mechanisms, they're not making portfolio decisions. They're making sovereignty decisions. The West has leveraged its gold 97-1 through paper multiplication. The East has accumulated physical metal and built alternative settlement infrastructure. Promises versus possession. Digits versus atoms. The trap is now visible. If gold prices rise to reflect physical scarcity, perhaps $3,500, $4,000, matching Moscow's current physical prices, Western institutions with massive short positions in paper gold face catastrophic losses. Their derivative books explode. JP Morgan's $312 billion in exposure becomes unmanageable. Settlement demands surge as paper holders rush to convert before prices rise further. The system breaks. But if Western central banks intervene to suppress prices through additional paper selling, more futures contracts, more unallocated gold creation, more leveraged promises, they validate Russia's position that paper prices are artificial. The divergence between paper and physical widens. Eastern accumulation accelerates. Physical drains from Western vaults while settlement stress intensifies. Every intervention worsens the underlying problem. The Federal Reserve cannot print physical gold. COMEX cannot increase margin requirements beyond levels that trigger mass liquidation. The LBMA cannot deliver 97 ounces when only 1 ounce exists in vaults. Russia's rejection of paper pricing removes the pressure valve that has contained this system for 7 decades. This is a pincer movement with no retreat. Eastern powers accumulate physical metal while building alternative settlement systems. Western institutions expand paper claims to suppress prices and maintain dollar hegemony. The mathematics don't care about geopolitical objectives. At 97-to-1 leverage with 11.3% settlement demands and Russia mandating 18% premiums for physical transactions, the gap between paper fiction and physical reality becomes unbridgeable. The last time leverage this extreme faced physical delivery demands at this scale was March 1968, when the London gold pool collapsed. 7 central banks had collectively sold gold to maintain the $35 per ounce Bretton Woods price. By March 1968, the pool was selling 100 tons weekly. On March 14th, they sold 400 tons in one day. By March 17th, the pool dissolved, the price peg abandoned. Within 3 years, Bretton Woods collapsed entirely, and gold reached $850. The mechanism is identical. A leveraged paper system, defended by institutional selling, eventually faces physical demand that cannot be satisfied at artificial prices. Intervention increases until intervention itself becomes unsustainable. Then the system breaks. There is no policy response that doesn't accelerate the outcome. Suppress prices through paper selling, and Eastern powers accelerate physical accumulation while building alternative settlement infrastructure. Allow prices to rise toward physical reality, and Western institutions face derivative losses that threaten systemic stability. Russia's directive ensures that any suppression in London creates larger premiums in Moscow, Shanghai, and Dubai, advertising the divergence to every sophisticated actor globally. The question is not whether the paper gold system can continue functioning at 97-to-1 leverage with Russia rejecting price-setting authority. The question is how quickly other nations follow Russia's precedent and demand settlement at prices reflecting physical scarcity rather than paper abundance. Central banks outside the Western system are accelerating accumulation. China added 310 tons in November through official and state entity channels. Russia absorbed 499 tons year-to-date. India imported 287 tons in 10 weeks before implementing export restrictions. These are not speculative trades. These are positioning decisions made by sovereign powers that understand the difference between paper claims and physical possession. Sovereign wealth funds are reallocating from gold ETFs, which hold unallocated paper claims, into allocated physical storage with independent custody. Large institutions are demanding delivery on futures contracts rather than rolling positions forward. Refineries report unprecedented demand for good delivery bars meeting London Bullion Market Association standards, suggesting entities are preparing to settle or demand settlement on large positions. The informed are not reacting to price movements, they're observing settlement mechanics. They're watching negative GOFO rates indicating physical scarcity. They're watching $8.3 billion in Federal Reserve emergency liquidity injections. They're watching 55% margin hikes, the largest in COMEX history. They're watching Russia reject 70 years of Western price-setting authority and mandate 18% premiums for physical transactions. The question isn't whether to panic, it's whether to understand. Markets can remain irrational longer than you can remain solvent, but not longer than physics permits. The ratio of paper claims to physical metal is a physical constraint, not a market opinion. When 97 entities hold claims to 1 ounce of gold, and 11.3 of those entities demand delivery, and one major power rejects the paper price entirely, the mathematics resolve in one direction. In your hand right now is that gold coin. 1 troy ounce, 31.1 grams. In 1971, worth $35. Today, London shows $2,680 on your screen. But in Moscow, that same coin trades at $3,847. In Shanghai, $3,162. In Dubai, $3,594. Russia just announced it will no longer recognize London prices for domestic transactions. The divergence between paper promises and physical reality is not a temporary dislocation. It's gravity, reasserting itself in a market built on leverage. And Russia just removed the mechanism that has kept that leverage stable for 70 years.